Hello, this side Kritika Chandarana, and today we are going to talk about the new fund offer, Nippon India Active Momentum Fund. And today we have with us Mr. Rajesh Jayaraman, who is going to share his insights about the new fund offer.
Thank you, Kritika.
So, sir, I would like to ask you this question about how does the Active Momentum Fund work, and how is it different from the other factor investments?
So it's an interesting concept actually. So we know factor investing offers a lot of advantages. For example, it brings in rule-based investment, systematic way of investments. Active momentum largely relies on momentum as a factor, but it tries to add and tries to overcome some of the shortcomings which can be potentially there from a momentum as a factor.
Okay, thank you, sir. What is the stock selection approach in the Momentum Fund, and how many stocks does the fund hold?
Sure. So this product will largely focus on the better quality, better liquid kind of names. So the primary universe is 500 companies by market capitalization, within which primarily the focus will be on the top 250 names, and the fund will run a focused portfolio of about 30 stocks.
Okay. Does the fund follow a specific framework?
This question actually. So we have a fairly detailed framework for this fund. So the fund actually, as I said, leverages on a factor called as momentum. But the way of looking momentum, what we have done is we have put in multiple factors. So this is a model-based fund. So it combines the elements of pure factor investing, which is momentum. It also adds an additional factor like earnings momentum. So it's a combination of two factors, price momentum and earnings momentum. So why do we look at earnings momentum? Earnings momentum in our view is more fundamental in nature. It gives a good representation of what is happening today from a fundamental point of view. And this particular factor also is very dynamic and agile, so it can adapt to changing market conditions much faster.
Oh, that's interesting. So can you throw some light on the model of this particular fund in detail?
So in fact, I'll just take you back to the genesis of this whole model. As I said, it's an improvement on the momentum as a factor. And what we noticed was momentum at times can be subject to some bit of challenges or pitfalls which can happen from time to time. So at least two major challenges for momentum as a model really comes in when there is regime shifts, when there is a huge shift in the market trend. So you could say the market is moving from a bullish to a bearish trend, or there are some macro events which keep happening because of which there's an impact. So the idea was, can we improvise that through a model-based investing, which is what we are attempting to do in this particular strategy. One more pitfall, which pure momentum, which primarily works on price momentum as a concept, can really happen, is that the portfolio quality at times can get diluted. Because you're just looking at the price, at times the price may not be fundamentally bad. So we have tried to overcome some of these limitations which can be there in momentum as a factor in this particular strategy. And hence our fund would look at 4 different indicators, 2 of them being indicators which are going to be there all along, which is price momentum and earnings momentum, which is always going to have equal weight, so they will be considered in an equal manner. But there are times when we want to identify the shift in market trends. So therein we are putting 2 conditional factors, which are additional conditional factors. It may not be there at all points of time, but just to identify whether the market is an extreme kind of scenario, extreme positive, which we call as bullish, or extremely bearish kind of scenario, we use 2 additional factors which are conditional. So one is trying to look at the areas when the market is extremely bearish. How do we look at? We look at a ratio called as Sensex to total market cap ratio. It gives us some sense of understanding. Similarly, we also look at the daily moving averages. So both these are additional factors which we use, which help us decide, is this a time to add risk to the portfolio? So we use a separate factor called as beta to do that, or is it a time to lower the risk of the portfolio? So then we look at minimum volatility as a factor. So net to put it very simply, there are 4 different factors. Hence, it's a multi-factor model, which is the framework based on which this strategy is devised.
Thank you, sir. Looking at the current market scenario, when we can see a wave of correction in the market, why should one look at investing into this active momentum fund of Nippon?
I'm glad that you brought up this question actually, because the whole reason of showcasing why the framework in the previous question which was answering is that currently, obviously everybody knows the market situation could be a little bit more volatile than what we have seen in the last few months. So therein, this factor called as minimum volatility, which we analyze when we do the stock selection or for the portfolio construct, that gets an additional weightage. So we ensure that the portfolio's risk management capabilities are slightly better in such a scenario. Similarly, if the scenario was reversed, say for example, the market trend was shifting and things were getting more positive for the markets, we would have used a factor called as beta, and that would have helped us understand or try to capture the upside possibilities much better. So that is where we think this model can add a differentiator. The model can actually help to improve upon the pure factor-based kind of strategies.
Taking it forward to your answer, which people usually ask is, should one go for a lump sum investment in this particular fund, or one should opt for staggered investment via systematic investment plan?
So this is one of the most important questions, and the questions which keep happening from every other time. So it's a continuous kind of thing. So it's an eternal conundrum, if you want to say it, from an investor's perspective. Should we put it in lump sum or should we do the staggered kind of route? So here, as I explained to you, the product actually does a lot of risk optimization or risk management through some of the factors which like beta and min vol, which I had explained. So given that kind of a adjustment of risk which happens, we think even a lump sum can be considered in this fund irrespective of the market conditions. But then there are obviously a lot of investors who would want to try and diversify more or try to reduce the volatility in the market by staggering their investments. So even SIPs is more than welcome. So you can do SIPs in this product, you can do lump sum in this product, or you can even do a combination of lump sum plus SIPs. So that will help you have best of both worlds also, to say so. So that's how people can look at it. We think all kind of investments, all kind of strategies can work, and that's what the model has been designed for.
Thank you, sir, for giving us insight about the new fund offer. So any message you would like to give to our viewers about the fund?
Thank you, Kritika. Pleasure speaking to you. So we think it's an interesting proposition which the investors can consider. What we're attempting to do here in this particular strategy is to combine the benefits of factor investing by looking at momentum as a factor, but we are trying to enhance and trying to overcome some of the limitations which potentially can be there by using multiple factors. So we believe investors can look at this product based on their risk appetite, and it can be considered as part of their overall allocations. So that's all. Thank you.
Thank you, sir. For more details about the fund, please refer to the link below. Thank you.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.